All right, Rajat Rajgarhia joins us now. Let's take a conversation forward with Rajat to understand what he makes of the market setup. Rajat, good morning. Thank you for joining us. It's been a tough and a rough year. Do you think we are done with the volatility and with the price adjustment for the year now?
Nikunj, good morning. Well, I don't think that the volatility is off because the volatility is a function of so many events that we are learning to live with, right? While COVID was one event of 2 years, this year we have event right from big changes in the central bank's commentary across the world, to the Russia, Ukraine, and to the volatility that we continue to see on the government policies, and this is across the world, where everyone is trying to protect more for their own domestic consumption. Markets will keep reacting to these events, right? And I think this just may well be the story for the rest of the year.
Rajat, so I'm wondering whether this is going to be a year of no return, low return, or reasonable return.
The year also becomes a long term when you have volatility like this every quarter now, right? And I think the kind of price changes that we see into stocks, and I'm talking about large caps here, where they move down 30-40% and they move up 50% within a same year, right? Basically means that maybe beginning of the year to end of the year, the stock price may be flat, but you may have done a full roller coaster ride into those names. So this is a year when stock picking will become very important, not just when you are buying, but also when you are selling, because the volatility will create many actions for people.
And that is the trick, right, Rajat? What you buy and what you sell. So tell me, what are your portfolio overweights and underweights?
So, if you look at our house reports, our strategies, Gautam, he builds this model portfolio. And the three things that we are discussing with clients right now, I think notwithstanding the volatility that the bond markets and the interest rates are creating, when you look at banks as a whole pack, you definitely continue to feel good because, a lot of the story still continues to be in their favor. The only one missing link right now is when does the credit growth starts becoming, more like a 12-14%. It's a question of wait and watch rather than whether it will happen or not. And the balance sheets are starting on a very good note. I think most of your guests, most of the investors know about this, but the correction that you have seen in the banks is a lot to do with the sell-off that we have seen from FIIs. That has created a better price opportunity into this sector. Secondly, one theme which I think is emerging as one of our favorite themes is this domestic travel and tourism. So I think what the last 3-year trend has done, especially led by COVID, we are seeing the trends of people spending more right now rather than saving the entire upfront. And if you look at, whether you look at hotels, you look at flights, you look at other ancillary to this travel and tourism, I think the outlook is very, very positive. You would have seen the guidance given by some of the listed hotel companies in their post-earnings con call. This is to some extent a cyclical sector, but I think that the best of the cycle is ahead. So this is one space again which we are quite positive on. And the third, which you guys were just discussing, I think autos, when you look at the price point into the market, after a period of, I think, 3-5 years, they are making new highs when the market is nowhere closer to the new high. So this may be a classic case where stocks are moving up and the business trends can start looking more positive as we move forward into the year. So these are the three spaces that we think investors can focus upon now.
I just want to build on that point on Rajat's analysis on auto, just for the benefit of our viewers. And Rajat, I'm coming right back to you. The auto sector actually got into trouble in 2018 and 19, which is that this is one sector where the problem actually started before COVID. So it's been a lot of years of consolidation for the auto sector per se. Rajat, there are multiple trends in auto. One is this big picture argument, ICE versus EV. Then there is this big picture argument on export versus domestic. What is the right way of looking at auto?
Well, I think while EV is something which can be a multi-year story, but that to make sense into the listed market cap will take take some time. I think the next 12 to 24 months, you have to play the normalization of the profits for the sector. You rightly mentioned this sector started getting hurt well before the COVID. COVID only compounded the problems, and then you had this entire supply chain and followed by the raw material price inflation. So almost every script that you could have written that should go wrong for them went wrong, right? And I think slowly and slowly you are now seeing some recovery trends happening. Still maybe early, but I think the underperformance, the valuations, and the hope of a better recovery is what is making this space well. Coming to export versus domestic, I think you have to essentially play still a domestic story, because if domestics will not do well, then exports are not going to move the market caps up, given that a large part of the earnings still come from domestic for the entire auto pack.
There now seems to be a realization and adjustment in those crazy high-flying PE stocks, Asian Paint, Jubilant, Bajaj Finance. Do you think this PE compression or this derating of price multiples, it will be an ongoing story for some of these haloed stocks?
No, Nikunj, you can also correlate them also to the trend of large FII outflows and domestic inflows, right? A lot of the stocks that you just spoke about, and many more you can add in that bucket, typically have been a favorites or of the many offshore funds, and we have been seeing continuous selling by them over the last 1 year, more so in the last 6 months, right? These are the stocks that they own. These are the stocks that they are selling. I think at all points of time, the multiples never made sense, but you always had holding concentrated with few investors. These are great companies, but after a particular valuation, they may not become great stocks. So this FII selling and less interest by domestics, even if they have fallen by 20-30%, is ensuring that we will see more correction into these names. Also, this market is changing its character where they are moving more towards value. They are more moving towards growth at reasonable price rather than growth at any price. This trend may not change because a large part of the money will still come from domestic over the next 1 to 2 years. And they are very, very valuation conscious when they look to buy stocks.
So when we talk about compressions and the sell-offs, you started to see a reversion in one pocket, Rajat. If you look at Paytm, it's up 8% for a year, for the month. You got Zomato, which is higher by 15% in 2 days. Nykaa, after missing street estimates as far as earnings go, still went up 3% at closing bell yesterday. The question I want to ask you is the comeback that you're seeing in the new age stocks, going with your theory of the reopening trade as well. What do you have to say for these newly aged IPO companies?
Well, we keep just talking about one correlation. When you look at 2000 to 2003-4, right? You had the Indian IT sector. Maybe pardon me for the numbers. I may be a little off, but in 2000 peak, you may had maybe 30-40 IT services companies making crazy valuations. Out of that, maybe about 8-10 survived. But for the subsequent 3-4 years, their profits doubled, tripled, but the market caps halved. I just think that there are many great companies that you just spoke about in that list, but for them to be great stocks, they will have to go through their own period of maturity, consolidation, more valuation correction, right? And maybe some change of hands, right? Do I have a view for the next 1-2 years on them? Right now, no. But I think out for the next 4, 5, 7 years, there would be very few winners out of this list. And whichever those would be, they would be definitely bigger market caps.
Okay, so wait and watch seems to be the advice coming in for you. You talked about IT. Do you think the IT pack is now cheap? We had seen a sell-off. There seem to be two schools of thought. One, that we will continue to see a decline, particularly in the mid-tier companies.
Look, the mid-tier companies stopped making sense on the valuation well before this sell-off happened, right? But they continue to move up. And I think even if they grow their earnings at 15-20% next 3 years, the stock prices are unlikely to make gains because they still stand very expensive. As far as the tech is concerned, we see reports about recession, about how the sector can see through derating. We spoke about very expensive. As far as the tech is concerned, we see reports about recession, about how the sector can see through derating. We spoke about Infosys fell 30% from its high in the last 3 months. That's a lot. From a 30p, it became almost like a 22, 23p. I think these are, at least the larger cap ITs are very solid names. The valuation today make lot more sense, right? But do they fly off again back to a 30p? Typically, when you see such sell-off, stocks consolidate, people wait for more conviction, and then the price action follows. But I think the large cap IT definitely makes lot more sense. Mid cap IT, I think valuation still needs to correct, even if their earnings grow.
Rajat, I'm still wondering, how could LIC fail? It was such a reasonably priced IPO, a must-have in everyone's portfolio. But look where it is right now.
Well, I think there is no doubt that it's a very good company. I also think that the way in which the IPO size, the pricing, etc., was done was quite commendable. And definitely it is surprising where it is trading now. But I think it's also a function of the markets. You are seeing institutional flows at best being neutral every day. One segment is a buyer, another segment is a seller. Secondly, you also see many other IPO listings. A lot of them have traded below. But just let this phase pass, right? And post this, you will start seeing stocks becoming maybe slightly more reasonable or rational, right? I won't be surprised if when we see a more sustained recovery, coming in the markets, you will see LIC again moving back closer to its IPO price.
Okay, Rajat, good having you on the show as always. And by the way, we're all up and running now. You should come to the studio next time.
For sure.
Okay.
Thank you. Have a nice day.
You too. See you soon. Okay.